You can open two Forex charts at exactly the same time and see one of them barely moving, while the other is flying everywhere. The fast one looks exciting. It looks like opportunity. And the quiet one looks like nothing is happening. But what if the quiet chart is actually the safer, cheaper, more professional place to be? We've been talking about sessions, overlaps, and the hours when the big desks arrive. Now we need to answer the question underneath all of that. What does liquidity really mean? And is more movement actually better? By the end, you'll know what liquidity changes on your screen, why a fast market can still be a bad market, and how to tell movement you can work with from movement that simply works against you. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. First, strip the word down. Liquidity is simply how easily you can buy or sell something without having to move its price very far to do it. In Forex, it means there are lots of willing buyers and sellers around the same price at the same time. Not one person shouting a number across an empty room, a crowded room with plenty of people ready to take the other side. That sounds abstract, but you have already seen its first consequence: the spread. In the spreads video, we said that Euro/USD is cheap because there are so many participants competing to buy and sell it. Liquidity is the reason that competition exists. More people at the table means the gap between the buy price and the sell price gets squeezed tighter. Imagine selling a house on a street with one interested buyer. You don't have much power. If that buyer wants a discount, you either accept it or wait. Now imagine selling tickets to a sold-out final outside a stadium. 10 people want the same ticket right now. You can sell quickly, close to the price you expected, because the next buyer is already standing there. That is what a liquid market gives you: a fairer price, a faster fill, and less drama between the moment you press the button and the moment your trade exists. Your platform may make every order look instant, but underneath it, your order still needs somebody willing to take the other side. Liquidity is the crowd waiting for it. And this is why the same pair changes character during the day. Euro/USD at the London-New York overlap has Europe and America both awake. Banks quoting, funds trading, companies hedging, and algorithms competing for every fraction of a pip. Euro/USD near the New York rollover has many of those same people gone home. Same pair, same chart, completely different room. Now, liquidity does not mean price stays still. That is the first mistake people make. A liquid market can travel a long way. In fact, the cleanest big moves often happen when liquidity is deep, because there is enough participation for price to keep finding the next level, instead of jumping around nervously between empty spaces. Think about the London Open we just covered. Price often leaves the Asian range with purpose. There is more movement, yes, but there are also more orders, tighter spreads, and more eyes on the same levels. When buyers are genuinely stronger than sellers, the market can move, pause, test a level, and continue. That is movement with an engine behind it. The opposite is a thin market. Here, price can move fast for a much less impressive reason. There is simply nobody nearby to stop it. One modest order hits a shallow book, skips over a few prices, and suddenly the chart prints a dramatic candle. It looks powerful from a distance. Up close, it is often just an empty room echoing. That distinction matters because your chart only shows the result. It does not put a label above every move saying, "This was real participation," or "This was a gap between orders." You have to learn the context. What time is it? Which session is open? Is this pair in its natural home hours? Is a scheduled number about to hit? Those questions tell you much more than the size of one candle. Here is the uncomfortable truth. The biggest candle of the day is not automatically the best opportunity of the day. A huge move at 8:30 New York time can come from a jobs number, an inflation surprise, or a moment when everyone needs to reprice the dollar at once. It may be very liquid in one sense, enormous volume is arriving, and still be extremely hard to trade because the price is changing faster than a normal plan can keep up. So liquidity and volatility are related, but they are not the same thing. Liquidity describes how easily the market absorbs buying and selling. Volatility describes how far and how quickly price moves. You can have high liquidity with moderate volatility. That is a busy, orderly market. You can have high liquidity with high volatility. That is a major news moment. And you can have low liquidity with high volatility. That is often the dangerous one. Picture 3 roads. The first is a wide motorway with steady traffic moving at a sensible speed. That is a liquid, orderly session. The second is the same motorway during a storm, with every car suddenly braking and changing lanes after an alert. There are still lots of cars, but it is not the moment to pretend driving is easy. The third is a narrow country road at night. One unexpected truck forces everyone else into the ditch. Fast does not mean safe. This is where beginners get trapped by their own attention. Slow price feels boring, so they start hunting for the chart with the tallest candles. Then they end up in an exotic pair during a quiet hour, or they jump into a release they did not know was scheduled, and call the result volatility. Usually they did not find opportunity. They found a worse price, wider spreads, and less room for a mistake. Remember the rollover window after New York closes. We said to leave roughly 21 to 2300 UTC alone because even major pair spreads can widen. That is not because Forex has stopped existing. It is because the market has fewer participants at the exact moment you need someone to take your order. The quote is still on the screen. The quality behind it has changed. And this also explains fakeouts better than any magic theory does. In a thin environment, price can push through a level because there is not enough opposing interest close by. Then real participation arrives, sees that price as too far, and pulls it straight back. The level did not become meaningless. The move through it just did not have enough people behind it. But be careful. Liquidity is not a strategy, and it is not a signal to buy or sell. Knowing that London is active does not tell you where to enter. Knowing that the overlap has the tightest spreads does not give you a stop loss. This course gives you the map of the market. The technical analysis course teaches the structure and confirmation, while smart money and ICT go deeper into why price reaches for pockets of resting orders. What liquidity does give you is a filter. Before you look for a trade, you can ask whether the market conditions are helping or charging you extra for being there. Is the pair active in this session? Are both currencies awake? Is the spread normal? Is a major release minutes away? If the answer is no, 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 and yes, you may have a chart open, but you do not have a good environment. Let's make that concrete. Euro USD during the London-New York overlap. Both currencies are fully active. The spread is usually at its tightest, and there is enough flow for a directional move to behave like a move, rather than a series of random jumps. That does not mean you must trade it. It means valid ideas have room to breathe. Now compare GBP JPY at the end of New York, just before Asia properly begins. It can flash dramatic movement, especially if an order hits a thin patch. But the pound's home session is finished, New York is leaving, and Japan has not fully taken over. That is not the same kind of energy. The candle may be bigger. The environment is smaller. There is another trap here, mistaking a wide range for clean movement. A pair can cover 100 pips in a day and still be awful to trade if it spent those 100 pips snapping up, down, and back again around news. Range tells you distance. It does not tell you whether price traveled in a way that let a human plan, enter, manage risk, and stay in the trade. The movement you want to respect has a simple look at the market level. The right pair, in its right hours, with enough participation to keep costs reasonable and execution stable. It may be fast or slow. It may trend or range. The point is not to demand excitement. The point is to stop confusing noise with a market that is actually available to you. So here is a small homework exercise. For 5 trading days, choose one major pair and mark 2 moments, one during its active overlap and one during a thin hour. Write down the spread, the session, and whether price moved smoothly or jumped and snapped back. Do not trade the comparison. Just watch it. By Friday, the words liquid and volatile will no longer sound like the same thing. So what does liquidity really mean? And is more movement better? Liquidity means enough buyers and sellers are present for you to enter and exit near a fair price, with tighter spreads and more reliable execution. More movement is only better when it comes with real participation and conditions you can actually work with. A big candle is not a promise. A liquid market is an advantage. And in the next video, we deal with the thing that can override every session rule and every liquidity advantage in a single second: the economic calendar. Which releases matter, which ones are noise, and why a trader checks the schedule before trusting a perfectly good-looking chart. I'll see you there, trader. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.